In this video, a brief overview of fair value hedges will be covered, including a high-level review of the accounting for this type of hedge. What is a fair value hedge? An entity sometimes has exposure to risks, such as price or rates that are fixed or known. In other words, they are locked in. Or an entity may have a firm commitment, where the entity has a transaction that will take place in the future that has terms that are contractually fixed. This exposes them to changes in fair value. A common example is a fair value hedge of fixed rate debt. So, let's say that entity A issues $1 million in debt that has a 5% interest rate. As interest rates fluctuate, entity A is exposed to interest rate risk in that their interest payments are locked in. To mitigate this risk, entity A enters into a pay-floating, receive-fixed interest rate swap to hedge their fixed-rate debt. The use of an interest rate swap unlocks the fixed interest expense associated with the debt and results in interest expense that varies with the market rate, benefiting the company if market rates decline. The interest rate swap designated in a qualifying fair value hedge to the debt ensures the debt will move in line with changes in fair value throughout the hedging period. To recap, a fair value hedge is a hedge of the exposure to changes in the fair value of a recognized asset or liability or of an unrecognized firm commitment that are attributable to a particular risk. Before closing out this module, let's take a high-level look at the accounting for a fair value hedge. A derivative is always accounted for at fair value on the balance sheet. If the derivative qualifies and is used in a fair value hedge, the gain or loss on the derivative instrument is recorded in current earnings. The change in fair value of the hedged item attributable to the risk being hedged is booked as an adjustment to the asset or liability and is also recorded in earnings in the same accounting period. Because both the changes in fair value of the hedged item and hedging instrument in a highly effective hedge are booked directly through the P&L, any ineffectiveness will automatically flow through earnings. That concludes this overview video on fair value hedges. This video was brought to you by GAAP Dynamics. For more accounting-related content, follow us on LinkedIn.